All right, and we should be live. Welcome, everyone, to our ongoing series of live reaction videos to the new Fed guidance and the Jerome Powell press conference. This is becoming a nice ritual now where a few hours after the press conference, Axel Merk is kind enough to come on the program here and record a live reaction video to what we learned here with me. I've got a couple of prepared questions that I'll toss out to Axel just to get the conversation started, but then we'll start taking your questions here from the live feed. And this is something that if you are watching, whether live or on the replay, that means that you are a premium subscriber to Thoughtful Money's Substack. So I hope you're enjoying this premium exclusive content with Axel, and we'll endeavor to do more of these type of things if you all indeed value this type of format. Axel, thanks so much for joining me.
Great to be with you for this ritual.
Great, and let me get the visuals a little bit better here for folks. I like this better. All right. Well, look, Axel, I always call you a Fed watcher, and I know you don't like that description. You're really a capital manager who is forced to follow the Fed because the Fed's decisions have big implications, whether we agree with them or not. You've very consistently on this program said that what the Fed lacks is a framework here by which it makes decisions, that you feel like it makes decisions much too much on sort of an ad hoc basis without, guiding set of principles or framework, as you said. Does today's FOMC change that opinion at all, or is this just more of the same?
Not at all, except I think I seem to have another support in that view. Arian pounded on that today as well, although he had a different take on it. He thought that the Fed should give more forward guidance, and that would provide a framework. As you know very well, the reason why the Fed does what it does is because the institutional setup is just very flawed. There's this big committee, they get together in meetings, and then ever since 2008, they've taken the guides that the market has away by paying interest on reserves, by QE and all these things. The yield curve doesn't give information anymore. The New York Fed used to set interest rates by intervening in the markets, and through that gather information on how healthy the banking system is. Now all they can do is read the tea leaves like we all do, and so today was the turn of the CPI print, and the effect is, and that's why I mentioned Arian, is we have this tremendous volatility in the market, because whenever a new data point comes out, we kind of scramble to reinterpret what might Powell say. Now, if you've listened to us discussing this, we of course already knew what he would say. But other than that, the market seems to get all excited about this.
Okay, well, let's talk for a second about what Powell actually said, just for the folks that didn't have a chance to watch as closely as you and I did. I think the key takeaways are no change to the Fed funds rate, no change to the pace of QE. So sort of we're keeping everything as is. Probably the biggest bit of news, if you will, is the Fed saying that they shifted their rate cut expected schedule a little bit. They basically shifted one rate cut from 2024 out into 2025. So now they're really only expecting one rate cut this year, and I think it's now 4 for next year, up from 3. So total rate cuts over the next year and a half haven't changed, but just the timing that they think they're going to deploy them has changed. So some might take that as hawkish, but at the same time, Powell took both in the Fed's minutes, but also Powell took pains to change his language a bit on inflation, basically saying, hey, we think we're actually beginning to make some real progress on it. We just want to see more progress before we get to the level of confidence we want to be at before we start making rate cuts here. So he basically said, we're just going to watch the data. If we start seeing a string of months that come in like this month, yeah, maybe we might actually pull those rate cuts in a little bit and do more this year. But right now we're going to play it safe, and we're guiding the markets to just one rate cut. Anything else in terms of what was said today you think is important to flag for folks?
And let me just expand on that just a little bit, because you nicely summarized it, but there is a little bit of a tempest behind what you just said. Notably, what you're referring to is the so-called dot plots, the forecast that the FOMC officials make, where they all in secret make a prediction. And sure enough, the quote unquote median on that suggests one more rate cut. But there's absolutely no agreement on that. There are some that say no rate cut, some say one, and some say two. So in that sense, there's a dispersion there, and we know as much as anybody else on that. But the other part of that is we, of course, had the CPI numbers, the Consumer Price Index released this morning, and there was a huge question mark. Well, do they make these dots, these forecasts, before the CPI number gets released or after? And somebody asked the question, and Powell said, well, they make the forecast before, but they are able to change it, meaning that this dot plot reflects the latest information. And so some of them, again, jump to conclusions what that means. I would like to just caution to overinterpret any of this. Most of these folks are academics, and out of principle, they might not want to be guided by the latest data point, right? One of the answers, even from Powell, to a different question was, oh, no, it's the process that matters. It's the totality of the data. And so very few of them would jump to the conclusion that any one economic data point is going to change their forecast. Of course, it does in many ways, right? They're human beings. And so they get influenced by that. And ultimately, what you heard from the Fomc is the same that you heard from anybody else that said, oh, we got to wait for the data. I go back to what I've been mentioning, I think, on this program here for a few times. What matters is that the bias changed last October, that higher for longer is somewhat over, and now they're waiting for an excuse to lower rates. And today, with the CPI numbers this morning, gave us more in the direction of that excuse. Didn't quite give us that excuse yet. By the way, just sorry for rambling on here. The ECB had a press conference the other day, interest rate decision. The one thing in common is both the ECB and the Federal Reserve, on the day they decide on rates, the ECB cut rates, they revise actually their inflation forecast higher for next year. So I thought that was an interesting added tidbit.
All right. Well, let me ask you this, since we're talking about rate cuts. So at the beginning of this year, there was a ton of enthusiasm for rate cuts, right? Powell basically did the verbal pivot at the end of 2023, and the market started this year basically expecting 6 to 7 rate cuts in 2024, right? And the S&P was priced at 47.50, right? So presumably that was what they thought fair value for the S&P was, with 6 to 7 rate cuts priced in. But now we're up at 5,400, and you would think, well, okay, that's pretty richly priced then, because the market was only expecting about 2 rate cuts at that point in time. Now the Fed just downshifted to 1, and the market jumped. So it just seems like no matter what the news is, it equals higher for stocks. Why is that?
So first, for those of you guys listening closely, you may have noticed Adam uses a different reference point than I do. Almost everybody, including Adam, refers to December Fed pivot. I refer to October Fed pivot. If you listen carefully to the press conference last October, I allege he gave a mission accomplished speech, but everybody else puts it to December. So do that.
Okay.
And by the way, if you look at the reason why that's relevant is, as you know, we manage a few bucks in precious metals, a little over $1 billion, and that market started behaving differently last October. And I believe it's because of pivot. And the reason why that's relevant for your question is because obviously the markets are forward-looking. The markets are forward-looking, and so we're getting closer to this rate cut. And by the way, at the time when more cuts were priced in, a more severe recession was priced into the market. And I think that's a very relevant data point as well. Remember, this is the most forecast recession ever. I was one of the ones who said it's going to be a more significant recession. And so as the market prices in more of a soft landing scenario, that's part of that, right? And so because the economy is doing better, the market is doing a little bit better. I'm not just trying to justify all the valuations here, but I'm trying to understand what the market is doing before I decide to disagree and take a trade the other way.
Let me just make one comment on that for you to react to. So if we were talking at the beginning of 2023, I would totally agree with you. But at the beginning of 2024, we were pretty well into kind of like a no landing, or at least a soft landing. And sure, maybe there were still some people that were a little doubtful, but not for nothing, Q1 GDP came in at 1.6, I think downward revised then to 1.3 or something like that. So, I don't think there was a huge change from the beginning of the year until now in terms of recession odds. But actually, some data came in that suggests the economy is actually slowing a fair amount, which you think would also bring prices down. But for whatever reason, there's still a lot of euphoria pushing stuff up here.
I'm laughing here because I'm looking at one of the numbers on my screen. NVIDIA is up 152% year to date, which is so. I'm not giving an investment recommendation here, but obviously, I'm not trying to say that it's all rational. I'm just trying to when I see something in the market, before I say everything is mispriced, I'm trying to understand of what is happening, why is it happening, and the other thing that is happening, which I think is relevant, is that the change in attitude by Powell eases financial conditions. And so while rates don't necessarily come down, credit is more readily available. Now, clearly there are corners where it is not, and we haven't seen huge moves in the credit spreads, but we have seen in the work that we do on the gold mining side, that more funding is available to the sector. Obviously, that's in part due to the rise in the price of gold, but a lot of that I do think is very simply financing conditions. And when financing conditions are better, that does help businesses that are more credit dependent. Now, all that said, of course, the heroes in this market have not been those companies necessarily, but the Max 7 or Max 3 or whatever they are these days.
All right. Well,
I'm not trying to suggest here that is all perfectly rational. And by the way, we're still facing a downturn, right? And Powell said as much. Powell said that we are going to have that where we have a tight environment. Then he said the question is it tight enough an environment? But then he answered his own question pretty much saying, yes, it is sufficiently tight. And so then the next question is, well, when are you going to ease? And if one believes that this economy is slowing down, the question is, how far down are we going to get? And indeed, if and when that does happen, how will the markets react? And to just pick on NVIDIA here for a second, the one risk that's presumably underpriced here is the geopolitical risk. Let there be a new president who says something nasty about China, and let the Chinese put up some ships around Taiwan. I would think there's going to be a reaction in the market, and I'm not predicting that that's necessarily going to happen, but this market is looking at the glass half full on many issues.
Okay, yeah, and that's really the point I just wanted to make. I don't want to beat this horse too dead, but like when you go from 6 to 7 expected rate cuts down to 1, that's essentially like increasing the discount rate, right? It should have the same effect of increasing the discount rate, which is a factor into valuations. And I don't want to get too wonky for folks, but it just doesn't seem to be acting like that in this type of market, right? My opinion. All right, so you mentioned a couple of things which I thought were interesting, because Powell took questions on both sides, right? Or took some punches on both sides. One was, hey, look, economic growth doing well on average. And Powell actually did address the low Q1 GDP growth and said, there's some other factors. If you look at it, actually looks better than he's just sort of treating the Q1 as sort of an aberration for now. But no worries about economic growth worth talking about. Unemployment still very low. Kind of everything's sort of holding up right now, right? And so that's what brought up the hey, is your policy restrictive enough? Like everything you seem to be doing doesn't seem to be moving the needle on anything, right? So the way in which I heard Powell answer the question, and he didn't use these words, but I think he said, yeah, it's sufficiently restrictive because of lag effect, right? Because trust me, at some point this stuff's going to start biting, right? At the same time, you had, I think it was the woman from Yahoo Finance, she said, hey, why not cut rates this summer? If you're above the neutral rate and you think there's a lag effect coming, isn't it better to start cutting sooner and manage the landing versus stay too high for too long, then have the labor market, croak on you, and then have a bigger problem? So it's kind of interesting that he's getting pressure on both sides. But what were your thoughts about that?
Well, if they only had a model that they could reference, right? Indeed, there was an editorial by Charlie Ploss, and I forgot who else wrote it. Charlie Ploss is a former Fed official, who said, why don't, in these projections that you give, put in there what a Taylor rule would also stipulate? And if you did that, it would be much easier to address some of these questions, because then you could say, well, in the context of what the rules state, that's what we're going to do. And instead, they don't have a framework, right? And then it just comes about. So I would think it's very helpful if they were more specific on these sort of things. But otherwise, yeah, they just they're not winging it. But I think they should talk when they have something to say. And if the goal is to say as little as possible, then maybe they shouldn't have these press conferences in the first place.
Right. You talked about that last time. You actually think they
Yeah.
should just stop talking for the most part.
I think that would be very good. Would reduce volatility in the markets.
Okay, I got a few more questions, but we have our first from the audience here, from Greg. Let me show it here. What are your thoughts on what's been happening with the Japanese yen US dollar exchange rate? How do you expect the Fed or Yellen to respond? So, Axel, I'll let you take that one. That's right in your area of expertise.
Yes. Well, I mean, he was even asked that question, and then he
I thought that was funny.
backpedaled immediately and said, "Oh, it's the Treasury," and then he pivoted to another topic too, because he realized the more he talks, the more he can get into trouble. There's really
Right.
nothing
He
good
just
he
said,
can say.
not my purview, talk to Treasury, right?
Yeah, yes, and but at the same time, what was interesting is he did talk about higher import prices. I don't even know how he got to that. That he said that was concerning, and he didn't quite know why. Now, note this Friday, the next release on import prices is coming down. Import prices usually means your currency is too weak, and your import prices are moving higher. Of course, one of the reasons you have high import prices, he did mention that, is because of everything that's happening around the globe, right? Shipping things through the Red Sea got a little bit more expensive. The threat of tariffs and tariffs themselves make imports more expensive. So there are reasons why import prices are going up. And yes, that is inflationary. I've been arguing for a long time that the new state of geopolitics leads to a high inflationary environment, not necessarily high inflation, but everything else equal, deglobalization is a higher cost of doing business. Now, to answer your question here, the Japanese have a problem, of course, right? On the one hand, they're getting their economy, they're actually doing some good work in getting some of their economy more efficient, some of their businesses more efficient and whatnot. But they have a boatload of debt and then some. That if they were to normalize, they can't finance their deficits anymore. And so they got this disincentive there. And so the yen is an interesting target here, right? The Bank of Japan has made it very clear that they're willing to intervene. Um, that translates into speculators using less leverage, but it's very difficult to say how that's going to play out, because I mean, ultimately, if the Japanese get their act together and get a good economy in place, then they're toast, because then um, then interest rates going to move higher, and they can't afford that.
Okay. It's going to be really interesting as things play out over the next couple of years here, just because everybody's got their own set of vulnerabilities here, and I think we're just going to, we're going to see probably more extreme measures on almost every player to try to defend against what they fear most, and
well,
that may not be as
let me chime in on that, because earlier question I was a little short because I had lost my train of thought there. But the Fed is trying to micromanage ever more things, right? We're asking is why is the lag effect different and whatnot? And we've talked about this, right? When the Fed gives a rescue package to small banks that have mismanaged commercial real estate and interest rate risk. Well, that prevents a flushing out of the commercial real estate market. And of course, the reason is clear, because they're so heavily invested that you would have some systemic problems. But when you put a band-aid in so many places, then obviously 0% interest rates for a decade is also a band-aid, right? And that has the unintended consequences that people lock in longer rates. And so the consequences are manifold, but one of them is that interest rates are less effective than they have been in the past. And so getting away from these policies, there are many benefits from that. There are political consequences as well from these policies, but it's one reason why the classic economic indicators don't work as well anymore. It's because we're micro. And by the way, that's not an accident. Bernanke, in his book a few years ago, wrote that we could do this in many more areas, this micromanagement. I mean, think about command economy. That's kind of his dream world, where one can take care of every problem that might arise.
Yeah, and certainly the direction of policy, both monetary and fiscal, has been more intervention, over the past living memory. So,
well, and
why should we
largesse,
expect
right?
that
I
to
mean,
change anytime soon?
everybody wants to spend money because everybody has noticed that it gets you votes. Look at Mexico, right? The landslide victory there. You just give benefits to everybody, and the voters love you.
Yeah.
And with the rise of populism around the world, we'll see much more of that.
Okay. All right, folks. By the way, if you've got questions, please do ask them in the live chat there, and I'll keep pulling them. So you mentioned banks, and at one point, Powell said that, hey, banks are doing fine, and the vehicles we put in place following the little turbulence that the banking system had a year ago, they seem to be working real well, and basically said the banking system's strong. Now, I've heard a lot of other people say they've got a lot more concerns about the banking system. I'm not sure I know anybody beyond Powell who would describe it as strong right now. And of course, he's keeping rates higher or high for even longer now by potentially bringing rate cuts down to just one this year. And that just weighs like an ever increasing force of gravity on the bank's balance sheets there. So I don't know. Do you think he was being disingenuous, or what are your thoughts on the banking system right now?
No, he's answering the question that you didn't ask. Why does he have an easing bias? Because he needs to throw a lifeline to these banks, right? I mean, in many ways, of course, being at 5% or 5.5% is great, because then you have a lot of room downward. But he doesn't have the luxury to do that forever, because it would wreck these banks. And he wants to get out of these support programs from these banks. And so that's why he's trying to read something positive into every economic data that's released to get a step closer to cutting rates. And the CPI report is a godsend. And if you look at the tape, for example, there's a KBW regional bank index that is up 2.4% today. Hang on a second. Yes, it's up 2.4%. Now, obviously, that's just a day. Don't extrapolate that from a year, but there's a relief rally in that sector, right? Not giving a recommendation on that sector, but this tighter financial conditions, they need to ease further for the small banks, for those banks to survive. In many ways, it's a problem that's being kicked down the road, just like the S&L crisis was in the 80s.
So just help correct my thinking on this then, though. So the markets are totally reacting like indeed Powell has an easing bias and is continuing, to move the football towards where they want it. That's how the markets are reacting. But forever, I've just heard Powell say, no, I'm keeping high for longer. Like, it's been delay in terms of cutting. I mean, the market's expected he was going to cut.
That changed last October, and you may think it's last December, but it doesn't really matter. It changed last year. He said mission accomplished. He remember, he was petrified about the repeat of the 70s. He hasn't mentioned that anymore, and now it is just, when can we cut rates? Now, to the layperson, it may not matter, right? The rates are the same; they haven't changed. But what has changed is the bias, and it makes a huge difference. And I say that as somebody who's actively investing hundreds of millions in the market in
Mhm.
securities that are very dependent on access to credit in the markets. Now, it's not like the floodgates have opened, but the marginal change of the change in bias has a profound impact on the ability of these companies to have access to credit.
Okay, but if he had a real bias, he would just cut, right?
But he of course he is there is I mean I'm nasty and say they don't have a framework. Of course they do. They are haunted by the 70s, right? They know that moving too early is he doesn't want to have a reputation of an Arthur Burns. He's the guy who in the 1970s allowed inflation to get out of control, right? And say that is still in the back of his mind. But he has said he is really kind of he has a big relief in that, and I do believe that he is not making things up in that sense. He is of course pushing back against anything that would suggest any one data point is going to guide him, and so in that sense, one reason why I don't think it's helpful for him to talk is because the market is giving us the same information. We don't need him to kind of repeat it.
Okay. And I actually had a note here when that Yahoo Finance woman asked him why not cut this summer. He basically said, because I don't want to be Arthur Burns. He didn't use those words, but his answer basically said the same thing. All right. So the last question I thought was a really interesting one, which was, yeah, there were a couple questions that were asked. Maybe we'll dig into in a minute, Axel, just about the weakening consumer, or at least the consumers, the portion of the consumer universe that is increasingly struggling. And at the very end, he was asked about housing, and basically just, hey, if you cut rates, aren't you going to make housing unaffordability even worse? And he kind of evaded the question. He just said, well, we look at the totality of prices. We just don't focus on one asset class and worry about what it's going to do. But kind of almost back to my question about, like, no matter what happens, it means higher for stocks. Rate cuts are supposed to bring, or sorry, rate hikes are supposed to bring housing prices down. Didn't happen this time. And everybody's acting as if rate cuts are going to bring housing prices up, which they probably will. So what happens if the housing market gets the rate cuts it want? Are we going to see housing become even more unaffordable to the average buyer?
I think a lot of the unaffordability has been these many attempts by the government to subsidize housing. And that might sound perverse to many listeners, but what it does, what any subsidy does, it helps the current generation of home buyers. But ultimately, everybody has a certain amount of money that they can spend on housing. And so if that gets you more and you get subsidy, well, then they get into kind of lock into this something bigger. And if you don't have the subsidy, of course you can't afford it. But if nobody had the subsidy, then home prices in general would be lower. So these subsidies are what's pushing home prices higher. And in the U.S., we have a long history of allocating credit because your home is the American dream and whatever it is, right? Fannie and Freddie in the 1930s. That started it. Took 80 years to blow up. But Bill Clinton, the third way in the late 90s, trying to give more credit to low income people. George W. Bush, it's not one side on political side. His administration coerced Fannie and Freddie to lower lending standards, and that was then the catalyst that ultimately got us to blow up in the financial crisis. So we have a long tradition in trying to throw money at this problem, all of which gets home prices to be unaffordable for the next person in, just helps the current person who's in line. And so, yes, I mean, lower interest rates should make it more affordable. But ultimately, the cost of owning homes has gone up. And so it was just an article I think in the Wall Street Journal, right? It's everything. It's not just insurance that's gone up. Every single aspect of owning your house has gone up, and so people are sticking in their homes longer. They're taking longer to buy. What will happen, I think, if rates go down, that there will be more transactions on the commercial real estate side, more refinancing, which means we'll get clearing of prices, which means we will also have more failures of institutions. In the residential side, I'm not sure. I mean, the strong buyer, they seem to be very happy picking up homes when they see something that's somewhat reasonably priced.
Yeah, and look, I could easily turn this conversation into a housing conversation, so I'm going to try to avoid that. But right now, you basically, because transactions are so small right now on a relative percentage basis, that you basically just have the deep pocketed that are doing most of the transactions, and increasingly we have these deep pocketed buyers buying multiple houses. Right, they're
Yes,
seeing it
and
as something they have in a
but that's
portfolio.
but it's not. It's as much as I love to blame the Fed for everything. It's really the system as a whole. You have, if you take insurance for example, when you have a messed up insurance market, and we both live in California where we certainly have one, insurance becomes very expensive, which is a disincentive to buy homes as an individual. But if you are an institutional buyer, if you're a real estate fund, you self-insure. So it pushes the market towards big business and
Mm-hmm.
makes us individuals renters, right? And so there are it's screwed up regulations. Screwed up is a CFA level 4 term, so you may have to explain that to your viewers. But it's this good intentions paving the road to hell type of attitude, of
Absolutely.
implications that get us to where we are. And interest rates is one thing. Now, going back to the issue at hand is, how does housing affect monetary policy? Housing used to be a much more important component of the US economy pre-2008. That has changed somewhat. It's still important, but not quite as important anymore. But then the data, and that's part of the reason why Powell pushed back, the way that housing filters into inflation is completely messed up. They use this owner's equivalent type of methodology, which has a huge lag effect. And it's only in this cycle that many Fed officials started to understand it. Many of these, during normal times, people don't dig into these things, including many academics, unless they're data nerds that really dive into this particular aspect. And so it provides for a higher inflation number. But if I can just pivot here for 1 second, it ultimately depends on the bias of the chair. And I say that because we didn't talk about the ECB because there's a Fed talk, but Lagarde said inflation will come down. And we know that because our forecasts are so good. She said that without laughing. And the reference she gave is that union labor negotiations tend to look at the previous 3 years. And when they renegotiate last year, there was very high inflation. But now we know inflation comes down, and therefore we can cut rates. So with any of these numbers, be that wages there in Europe, be that housing, if the Fed wants to cut rates, they will give you a good story and we'll just eat it, right? They got the bazooka and we just have to deal with it.
Okay. Yeah, what I don't like about the bazooka is we now have multiple bullies on the block with their own bazooka, right? So we had the Fed with its bazooka, but we now have the fiscal side, right? And so, again, not to make this all about housing, but we have the proposal that's come out where Freddie Mac wants to get into the secondary mortgage market, right? The home equity loan market. And that could, as proposed, sounds like it could put billions uh, into the system
Why
this
do we
year.
need the freaking government in housing in the first place? This is supposed to be a capitalist country, right? And
You're singing from my song sheet, brother.
it's and expanding any power in that direction. But it's just that's what happens with government, right? Give them a little bit, then they build a bureaucracy around it. It's not needed, but it's a more powerful people than you and I have tried to change that, and it's.
All right. Well, I'm going to pull up this question here from Stan. You remember probably when Powell, was asked, "Hey, what words do you have for the Americans that hear this good economic news, but don't feel like it reflects their lived experience?" And he was a little stymied, right? He said, I'm not going to endeavor to try to, presume what someone is thinking." Um, well, anyways, I'll let you react to that first.
Why does he have a press conference in the first place, right? He's setting himself up for traps like this, and he
Mm-hmm.
practiced so hard. I'm not going to get my foot in my mouth today. I'm not going to say anything. And then he gets a question, and he says, "I don't know anything. I don't say anything," and that's the blurb that comes out. right? So, and then we get to tear him apart over it. I mean, you gotta feel sorry for the guy sometimes. But it's you remember before we had the great inflation, he talked about how they lower interest rates to help the little guy. He went all on this social engineering thing and how the Federal Reserve would help the little guy. Which was, I have no idea why he said it, because no, that's not the Fed's job. No, the Fed can do it. And now he's trying to stay away from it, but he gets drawn to it anyway. Um, and he said, he followed up with that and said that it wouldn't be appropriate for the Fed to tell people what they should think and what they should be happy about and so forth. So it just didn't come out right.
Well, it didn't. And
But
he said a couple of things I thought were interesting. They sort of reflected how central bankers think, I think. And one was he said, well, we're coming off this period, a long period where nobody had to worry about inflation. And we, the Fed, are trying to bring you back there, right? And I get it in one sense, which is, okay, as reported officially, we had under 2% inflation for a long time. But from a cost of living perspective, it sure as heck got a lot worse post-COVID. But people's cost of living was going up way more than the reported CPI year after year.
yeah,
So it did kind of sound a little tone deaf to anybody
yeah.
that had been paying for
Mm.
groceries or college or
Mm.
healthcare during the pre-COVID
Yeah.
period.
Well, it depends on which audience you're talking to, right? I mean, what he was referring to, of course, that ever since the 1980s, long-term interest rates have been coming down, and there's been a huge benefit to economic growth. But um, I- the last, I mean, since 2000, right, in particular, people are struggling, and there is a monetary policy had a role to play. And let me just expand on that because I haven't talked about that, I think, for several years. Um, Greenspan talked about how living on credit makes an economy more efficient, right? Because your monthly paycheck gets you much further. But the side effect of that is, of course, it makes society less shock resistant. If you live on credit, if you don't just buy your house on credit as you did until the 80s, but buy everything, including a mattress or whatever, your iPhone and everything on credit, when you lose your job, have a shocking event like a divorce, have a medical bill, then you don't have a buffer and you fall through the cracks. And then and on top of that, you have a change with globalization in the early 2000s, China coming on the scene, um, facilitated by US policies. US companies accelerate outsourcing because they're faced with these cheap imports. They're faced with high commodity prices at the time, and so they reduce the jobs to maintain margins. And the US worker is very flexible, but they notice something is wrong, and they get upset, and so they start voting in more populist direction because they just don't like what they see. So it's the whole package here, and Powell is trying to wash his hands clean of that. I think a lot of that is ignorance at the Fed because they are just so captive of what their mandate is, and they think that they're doing a good job.
All right. I want to talk about one more thing Powell said, and then I want to talk about something that Neil Kashkari said. And for those of you who don't know Neil, he is the CEO of the Minneapolis Fed, right? Axel, I get that right?
Yes, I was about to say he wasn't in the audience.
Yeah.
Yes, no, he is known for um, extreme, maybe not be the right word, but significant views. Yeah,
Okay. And I think is he a voting member, Kashkari, right now?
I might have to. I don't think so. He talks a lot, but well, he. Let's put it this way: he talks a lot. Different Fed officials influence the markets differently. Neil Kashkari less so than than others. Let's just put
Oh,
it this
okay.
way.
Well, so Powell said when that he was asked about, what's your message to Americans who don't feel very good about the economy. He said, well, the data shows the economy is growing at a solid pace, a quote, very strong labor market. We're in disinflation right now, so we're bringing inflation down, and we're working to bring it to a halt, which is not really true. He's working to bring it to 2%. They're still going to have inflation. And then I thought this was curiously accurate. And he said, in the meantime, it's going to be painful. Right? And so, there's a little honesty there. The fact that people are hurting and they might hurt for a bit longer. Um,
Well, he's getting
there's
people ready for a recession, right? I mean, that's going to happen if he is waiting, and that's going to be painful. Yes.
Yeah. Well, so I didn't. I'm always looking for the signals that he's saying, "Hey, inflation's coming." I didn't get a ton from this one. I mean, he did say several times, well, hey, if we see weakness in the job market, you put little precursors in there, right? But he kept talking about how strong the labor market is. Even though he did, I was surprised. At one point, he mentioned, "Hey, some people dispute, some of these numbers here," which, of course, you and I and many others have pretty loudly disputed some of this stuff. Do you think we have a quote very strong labor market right now, Axel?
No, that's the short answer. Just a few things you mentioned. So
Yeah.
Minneapolis Fed, Neil Kashkari, Minneapolis Fed next votes in 2026. On the data, I had a long discussion with a former Fed official about the birth-death model in particular, and I don't know how much you cover that on your program, but then
Enough that my viewers should know that people think it's overstating payrolls by like probably getting close to hundreds of thousands, seven, eight hundred
yes, well,
thousand.
exactly. Be vague, right? Because this most recent report, 231,000 jobs were created. The previous month, 363,000 jobs were created because of the birth-death model. Apparently, it now revises on a quarterly basis. There used to be an annual adjustment, only getting more confusing. So I asked this fellow who studied these reports forever, why, like, what is this all about? And and basically he said, well, it's a darn difficult job to estimate these numbers, and they're trying their best. Um, and part of it is you don't you it's very difficult to differentiate between businesses that don't respond to surveys versus businesses that have gone out of business. Um, and and then I said, okay, well, if it's such a guesstimate, why is it that the market takes it so seriously? Because this is the jobs report is the most important report pretty much every month. And his answer was, well, it is so important because it is the most immediate feedback we get on the labor market. It may not be the most accurate one, but it's the best we got. Many other reports have a substantially greater delay, and many of them are far less relevant to the jobs market. And so that is why people and so economists know the stuff is not accurate. They do it anyway because that's the best we got. The market wants to have it, and then they'll revise it. But the market jumps on it because obviously the market likes to jump to conclusions. And but we should be under no illusion that these numbers are anything from accurate. Now, to your question about the weakening labor market, yes, of course, this market is weakening significantly so, and Powell knows that. And when the Fed wants to slow the economy, almost always there is going to be a recession, and everybody always talks about the soft landing until the soft landing becomes a hard landing. What's unique here is the soft landing scenario has played out a very, very long time, and we haven't had the harder landing, but surprise, surprise, the Fed has not eased, right? And the Fed will not ease until we have more pronounced weakness, which also means because of the lag effect, guess what? I'm still in the recession camp. Um, and the market will price it in once we get there, right? And maybe we don't. I just happen to think that night follows after day, and therefore I think we'll get a recession. But I'm old
Okay.
fashioned.
All right. So it sounds like you're on team lag effect. Not that it matters, but most regular viewers know that I am too. I mention it all the time. Not to try to convince people necessarily, but to give a lot of the folks that I interview a chance to react to it and clarify their views. But it sounds like you think history is going to repeat here, Axel, where for most of the recessions in living memory we've had, they have followed a aggressive rate hike regime by the Fed, a plateau of those interest rates, and then as the Fed starts cutting, we seem to be in recession. I'm not going to say correlation or causation, but generally, usually the Fed realizes it kept rates too high for too long and kind of panic cuts as the recession fully arrives. So it sounds like you think that's the more probable outcome here.
Well, they certainly cut. The pace of cutting, I think, is not known yet. They will panic cut if the data is very weak, right? And who knows what other shock comes along the way. That's usually, it's one of the reasons why the market almost always prices in cuts in the future at some point, is because the unknown probability builds up over time, and at some point something might just happen. That said, what speaks against kind of the going, remember in history, we didn't always go down to zero, right? And the Fed would love to avoid going down to zero. Um, and so because we have overall a higher cost of doing business, I think that may well happen that we don't go to zero this time.
I was going to ask, do you think we'll get to zero? I would say no, unless there's a terrible crisis.
Well, what's terrible these days, right? I mean, if there's a risk of a systemic fallout, then yes. Yeah, define terrible. I guess that's the question here. They would
Something
love
bad
to.
enough to bring the Fed back to zero.
Yeah.
That's how I
Well,
define it.
many years ago, I had a discussion with Don Cohn, the former vice chair. This is more than 20 years ago, and I asked him, how is the Fed going to manage this or that? And he is strongly convinced that one just fine tunes things then, right? So the folks at the Fed think that they have control over this, and they can adjust to whatever needs adjustment. As a market participant and you as an observer, my guess is that their tools are rather crude, right? And sometimes they will say as much, but they'll cut rates, and if needed, they'll cut more. But their goal will be, and I wouldn't be surprised if it starts out this way, right? At some point, they will start cutting rates, and they will signal it's going to be gradual. And then, if and when economic data drop more sharply, then they'll cut more aggressively. But they'll at the outset say that they'll cut slowly.
Okay. One or two things, then we'll wrap it up. First off, I just want to give note to his comment. So Stan, who asked the previous comment or question, said, "Thank you. On a lighter note, I look forward to your new movie coming out next month, Axel." I didn't realize this. I just had to look it up.
Oh, no! I have to educate the audience here, because this is more important than the Fed meeting. In the 1980s, there was a movie, Beverly Hills Cop, with Axel Foley. Well, Eddie Murphy was playing Axel Foley, and so for decades, when people didn't quite understand my name, I said Axel, like Axel Foley in Beverly Hills Cop. Unfortunately, in recent years, there are not as many people anymore that remembered the movie. And so now on Netflix, and all your viewers, you have to give a free Netflix subscription to all your paying subscribers here. Netflix is going to have a new version of Beverly Hills Cop with Axel Foley. Now, an interesting tidbit about that is, in about 15 years ago, one of my kids was sick for an extended period, and I thought a good deal of culture is warranted. So I had her watch Beverly Hills Cop to get to know the true Axel Foley. What I had forgotten, and I got in trouble with my wife, is that Eddie Murphy does a great deal of cursing. But she watched it. She wasn't quite as impressed as I was.
Well, impressive that Eddie Murphy is reprising his role as Axel Foley in the new movie. Yeah. So it's still him playing the role. Also, too, and maybe Stan was alluding to this too, but folks may remember there's a Sergeant Taggart in the movie too. So you and I both have a bit of a connection to it, Axel. All right. Well, look, let's see here. Just on the Kashkari thing. So Neil Kashkari was interviewed relatively recently and was explaining to the interviewer his shock. He was kind of saying, "Hey, I'm sort of wondering why people don't give the Fed more credit for all its efforts to bring inflation under control." Again, kind of tone deaf that a lot of these issues are issues of the Fed's own creation, right? But he was talking to an organization that represents workers, and he was really surprised to hear that their preference would have been for a recession rather than for all the stimulus that contributed to the inflation that we've now suffered, right? And they basically said, yeah, I mean, we would have preferred the recession. Yeah, we would have lost jobs, but we know how to deal with that. And eventually people would have been reabsorbed in the economy. And we have ways, regular workers kind of know how to weather that storm and leverage friends and families and get, find new jobs eventually. But the inflation that we suffer is permanent, right? And, if you look at the data from Truflation, they estimate that inflation since January 2020 is almost 25%. And there's a lot of people who look at that and say, I think that's actually an underestimation, looking at my own personal experience. But basically, that means that the purchasing power of our wealth, of our dollars and our wealth, just got cut by a quarter in just the past 4 years. And we didn't vote on that. And my suspicion is, if we had, I mean, yes, to their credit, everything was bananas during COVID and everyone thought we were all going to die. But I think if you'd put it on a national referendum saying, what do you folks want? Kind of a brutal recession that might last 6 months, or have your wealth be permanently cut by a quarter? I think a lot of people would have said, hey, we'll take the recession.
Yeah. Well, there are of course many social studies on those sort of questions, and part of it is of course, well, who gave those sort of answers? It's always easy to, in the abstract, say, hey, yeah, we'll take a recession anytime. But if it's your job that's on the hook, maybe you're
Yeah,
not
sure.
quite as happy about it, right? And it's one of these reasons why you should never get off the rails in the first place, because once you are, it is just so darn difficult to get back onto it. And because there will be the popular backlash that they just don't like what the government is doing with you, right? And then the government is trying to fix it by giving a handout. Well, the subsidies I mentioned earlier, right? The subsidies are the ones pushing up home prices, and so similarly they distort markets and creating a fertile ground for dissent, and that then usually leads to populist politicians that again don't solve the real root problems. To just kind of round out the other end of that, Paul Volcker, the hero of the inflation hawks, I may have mentioned on your program, he said what a government needs to be stable is you need sound fiscal policy, sustainable fiscal policy, you need sound monetary policy, meaning stable prices, and you need sound institutions. And on each one of these buckets, we have seen in the US, but also globally, a significant deterioration. And when that happens, you're just putting in the seeds for instability, with all kinds of implications. And that's the world we live in. Now, it's a world that will continue. It will adapt, but it is one that doesn't need to be that way. And as you point out, right, it's one of the taxes that's very cruel is that of inflation, and it hurts the middle class the most, right? And it's just but in a world where you can't raise taxes, where you can't cut spending, that's the default thing, right? You finance things with inflation.
Right. Which, and just to remind folks, the interview I did of Thomas Honig, who ran the Kansas City Fed and sat on the FOMC, of all the things, in his outlook, that's the one that he feels the most confident in predicting, which is a continued erosion of the purchasing power of the currency, probably at an increasing rate, as long as we pursue the status quo. All right. So one last major question for you, although we'll just take a minute answer. You don't have it's a question we could spend a whole hour on, and it's not something that was brought up at today's press conference. But when we just sort of talk about risks that are not priced in right now, you mentioned geopolitics being one of them, or geopolitical risk. So right now, AI is still driving everything, right? NVIDIA, you mentioned, is up 150% this year alone, and we could have talked about how crazy the price was coming into this year. Apple just added a gargantuan amount of market value in the past 48 hours, literally just saying we're gonna add AI in the future. Not even AI that they're programming, by the way. So what is the potential risk do you see in today's markets of just kind of the bloom coming off the rose, or the honeymoon period ending with AI, where people are saying, all right, look, we've spent gargantuan amounts of money in CapEx for this, but where are we seeing the big impact to the bottom line? And there could be a risk that the market wakes up and says, oh gosh, we were kind of all pricing it in today, but it's not going to arrive until, some point way out in the future.
Yeah. Well, by the way, there's some governments now spending money on data centers because they have the glorious idea that they can allocate the resources well, and then they have to buy some expensive chips to make all this happen. I mean, many of you brought up Axel Foley. What many people don't know, I actually have a master's in computer science with focus on AI. That was a few decades ago, but I studied this stuff before it was hip. And so it's been long in the making. What has changed is that now we have a natural language interface to AI, which suddenly opens the doors to the world of possibilities of what you can do with AI. It also means that a whole lot of people that don't know how to use it will start using it. And so there's going to be a significant learning curve. In the meantime, you have the big guys buying these chips like crazy. So there will be no investment period. But I mean, in 2000, right, there was a hype about technology in general. I think the Nasdaq went down, was it 80% or more, 85% from the top to the bottom. But of course, the internet is still around, and some of the champions are still around and have thrived ever since. So I think AI is certainly going to be around. There are going to be ups and downs. But we also have the kind of the leaders in this space. The narrowness of that is getting to be very, or in parts has exceeded to that in 2000. And so I would be reluctant to put money into that leadership. Now, I'm not giving investment advice here. Let me just say there are different investment processes than people can have, and if you're happy chasing leaders and can make money with that, be my guest. But then don't come to me crying when you lose your money on the way down. I'm much more of a value guy who likes to put money elsewhere. But one of the things that happens, including at dinner tables around the country, is that, oh, this stuff hasn't worked for so long, and so I'm putting more money into NVIDIA. And that's the sort of thing that happens towards the end of the cycle. I don't know whether you talked about it on this program, but the CEO of NVIDIA signing the breast of a woman, right, at a conference, that's usually not the sign of a market bottom type of thing. And so, but then again, Greenspan warned about irrational exuberance in '96, and the market went up to 2000. So it's very difficult to time the market on the way up. The only thing I can urge people is think about what is your investment goal, and then whatever you do, is that consistent with that. And if, let's assume a radical portfolio that you have a 60-40% portfolio, 60% NVIDIA shares, 40% cash, just as an abstract example, and you had that at the beginning of the year. Well, your allocation, and I'm not suggesting that people have that allocation, by the way, but if you have that allocation, by now, NVIDIA would be a bigger chunk of that portfolio. And the prudent thing would be that you rebalance to 60-40. And I'm just using that as an extreme example because that's exactly what people don't do. They start justifying the winners and they forgot why they had an investment process in the first place. And then in 2009, when we were at the bottom, people had over allocated on the top, had lost more than they could afford to lose. And then people told them, yeah, you got to double down and put more money into stocks. And while that technically might have been the right thing, that's what's causing people to lose sleep at night and then sell out at further loss down the road. So having an investment process during times, especially when you have these very odd valuations, let's just put it that way, I think is a good idea. Anyway,
Very
that's a
well
little bit
said.
more than what Paulo said.
Very well said, and to be disciplined to the best practices of wealth building, like rebalancing. All right. So I'm going to give you in just a minute, Axel, a chance to give any concluding comments you may have about today's press conference. Very quick, folks, I'm just going to ask you for your feedback. If you continue to enjoy this format, please let me know, because if you do, we'll do more of these. Obviously, we'll continue doing them with Axel as long as he's willing to join us after each Fed presser. But maybe there might be other topics as well you'd like to see live interactive discussions like this on. So please, whatever feedback you have, let me know in the live chat right there. Axel, as we wrap up here, I just want to let folks know where they can go follow you and find you. And I'm going to pull up my little banners here. So one, they can go to merkinvestments.com, correct?
That's correct. We got a newsletter there. From there, you can also see what we do. I can't talk about products here, but yes, that's a good place to find me at.
Okay, great. And then if they want to follow you, they can follow you on Twitter, right?
That's
at
right.
Axel Merk.
That is right. That's where you can see me unfiltered. Yes.
Wow.
Well, I am. I wish I was. My speech is censored. It's one reason why I don't have more followers, because I I I just can't say the stuff that most people say. Um,
Because you're regulated.
yes, 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 yes. And I try to be conservative in what I say. So it's. But you will see there is plenty of sarcasm and cynicism. So it does. I can't resist.
Okay. And just very quick for folks watching, you all know this. For all things thoughtful money, just go to thoughtfulmoney.com. For those of you that are participating live or in the replay on the day of this video, you're already subscribers to our newsletter. If you're watching this on replay anytime after that, you very well may not be a newsletter subscriber yet. You can just go to thoughtfulmoney.com, click the newsletter link up at the top. And of course, we've got the form there to schedule a free consultation with one of Thoughtful Money's endorsed financial advisors anytime you like. Okay, Axel, as we get to the end here, I think we pretty well dissected today's Fed guidance and press conference, but any concluding perspective or remarks you'd like the audience to leave with?
Policymakers, for the most part, act with good intentions. It's the road that's to hell that's paved with good intentions, unfortunately. And so that's kind of what we're stuck with. And as the world is evolving, I think it's becoming less stable, which means you got to invest in your skills, because that's ultimately the best investment advice I can give, because you have a better purchasing power with more skills. Got to be prudent with the investments, which means have a process, and then invest in your health, because that's ultimately the way that you can actually enjoy what what you have around you.
All right. Well, very well said. And just a reminder to folks, I've known Axel personally and well for many, many years. He does practice what he preaches, both as an investor and as a marathoner and general lifelong fitness enthusiast. All right, Axel, it's been a joy. Thanks so much for doing this. I hope we can get you at the next time.
My pleasure.
All right, everybody else, thanks so much for watching.